Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers, your Monday, June 1st, 2026 edition. Hope you had a fantastic weekend.
Absolutely, Ethan. We've been digging deep into the data collected yesterday, Sunday, May 31st, to kick off your trading week with some fresh insights.
And what a mixed bag it is. We saw a really high volume of social media discussions, flagging quite a few different stocks across the tech, space, and semiconductor sectors.
Indeed, the overall market sentiment we're seeing today is a bit of a tightrope walk. There's a lot of promising AI-driven enthusiasm out there, but we're also identifying some significant underlying risks that demand caution.
So let's jump right into it and uncover what the AI has found for us today. First up, let's talk about SAP SEADS. There's some really strong bullish sentiment around this one, driven by its cloud and AI segments. We're seeing chatter about their cloud ERP suite revenue being up 30% and their AI copilot Joule getting shoved into every enterprise workflow. Plus, the cloud backlog is looking chunky, up 25% at constant currencies. It seems like the market views SAP as a stable, indispensable player.
Ethan, I agree. The user sentiment is overwhelmingly bullish, and for good reason. My KPI analysis confirms a strong operating margin of over 30%, which is fantastic and shows their efficiency. What's also interesting is that the current stock price is significantly below its 52-week high, suggesting potential room for recovery if this cloud and AI transition continues to execute. We've previously rated SAP as a buy in May, and based on this continued strong performance, the AI-generated insights maintain that stance. So for SAP, our verdict is a buy, driven by solid execution in high-growth areas. Next, let's move to Micron Technology, MU. This stock has been a real big hitter for many, with some users reporting almost 100% year-to-date gains. There's a lot of excitement about its crucial role in AI, with reports that their HBM chips are already sold out for the rest of the year. The AI-generated insights found a very low PEG ratio, suggesting potential undervaluation relative to its growth, and its net profit margin is exceptionally strong. Ethan, while the growth narrative for MU is compelling and those profit margins are indeed impressive, we can't ignore the risks. Micron carries a very high debt-to-equity ratio of almost 15. The stock is also trading with a high PE and PB, which could signal that a lot of that future growth is already priced in. And we saw some insider selling activity, which, while not massive, warrants a closer look. Given these mixed signals, especially that debt, we're holding our previous cautious buy rating.
So for Micron, it's a cautious buy. Great growth potential, but definitely keep an eye on that debt. Okay, let's talk about Microsoft, MSFT. The community is overwhelmingly bullish, with many predicting it will smash its all-time highs. Users are highlighting its enterprise dominance, Office, Windows, Azure, and how perfectly positioned it is for AI integration. They're talking about a reported $37 billion AI run rate and tightening AI tools. It really feels like Microsoft is seen as a bedrock investment.
Absolutely, Ethan. My KPI analysis for Microsoft strongly supports that bullish sentiment. We're looking at a robust 18.3% revenue growth and an outstanding net profit margin of nearly 40%. For a company of Microsoft's size, that's incredibly efficient. The price-to-earnings ratio is also reasonable, suggesting the market is valuing its strong fundamentals and AI leadership appropriately without excessive speculation. We've consistently rated Microsoft as a buy, and these insights reinforce that. For Microsoft, it's a clear buy, folks. All right, let's shift to Intel, INTL. There's some chatter referencing Intel's past pump from government intervention, like the CHIPS Act, and recent news about Supermicro launching new solutions with Intel Xeon 6 Plus processors. There's some minor insider buying activity, which could be seen as a positive sign. Well, Ethan, while those historical points are interesting, the current picture for Intel from a KPI perspective remains challenging. We're still looking at negative net profit margins and negative earnings per share, indicating they're years away from consistent profitability. The debt-to-equity ratio is extraordinarily high, signaling significant financial risk. Users were also quite dismissive of the AI Manhattan Project funding, calling it insignificant, so that's not moving the needle. Given its history of stay-away ratings and these persistent financial concerns, even though it briefly touched buy or cautious buy earlier in the year, the AI-generated insight here is a clear downgrade back to a stay-away. So Intel, despite some past highs and new product news, is a stay-away for now. Next, AMD, Advanced Micro Devices. Like Intel, AMD was mentioned in the discussions around that AI Manhattan Project, and there's a general belief in its strong revenue growth and strategic AI bets in Taiwan. We've also seen some insider confidence with positive buying activity. Many view AMD as a key player in the AI trade. Ethan, the community's enthusiasm for AI is certainly strong with AMD, but my KPIs raise significant red flags. The price-to-earnings ratio is exceptionally high at over 172, suggesting huge future growth is already baked into the price. The debt-to-equity ratio is also quite elevated, and the stock is trading very close to its 52-week high, meaning there might be limited upside from current levels. Crucially, the recent news about the US AI chip export clampdown on China poses a direct threat to AMD's future revenue. We've seen AMD fluctuate between buy and stay away, but with these current risks, it's a stay away. So for AMD, it's a stay away. Let's talk about Oracle, ORCL. This is another tech giant mentioned in the AI Manhattan Project discussions. Oracle has impressive revenue growth and strong profitability metrics, like its return on equity and operating margin, which suggest a company well-positioned in cloud and AI infrastructure. Ethan, while Oracle's profitability is indeed strong, the single most glaring red flag for me is its absolutely enormous debt-to-equity ratio, over 415. That level of leverage, coupled with a high PE, represents substantial financial risk, especially as they're investing heavily in AI data centers. Users were also skeptical about the AI Manhattan Project's impact. Oracle has been a consistent stay away in our past ratings, and that high debt continues to make it a stay away for now. Due to the significant debt, Oracle is a stay away. All right, moving on to Rocket Lab, RKLB. There's a lot of bullish sentiment here, with users seeing it as superior to competitors and praising its diversified business model, including satellite parts alongside launch services. It's often viewed as a leader in the commercial space sector, with strong revenue growth. Ethan, the market certainly has high hopes for Rocket Lab, as evidenced by that strong user sentiment and impressive revenue growth. However, when I look at the KPIs, I see a company with a negative net profit margin and negative EPS, meaning it's still unprofitable. The price-to-book ratio is extraordinarily high, at almost 36, indicating investors are paying a huge premium for future potential. But here's the kicker. There's been substantial net selling by insiders, which is a big cautionary signal. With high debt and insider selling, despite the optimism, this is a stay away for now. So for Rocket Lab, it's a stay away.
Next, Dell Technologies, Dell. This is another one that came up in the AI Manhattan Project context, but the real story is its incredible revenue growth, almost 88%. It's been hailed as an AI winner, securing massive contracts, including a $9.7 billion Pentagon deal. Analysts are optimistic, and insiders have been buying aggressively. The stock has surged dramatically from its 52-week low.
Ethan, Dell's revenue growth is undeniably exceptional, and that momentum is clear in the stock's performance near its 52-week high. But this is where the KPIs force us to challenge assumptions. Dell has a negative price-to-book ratio, which signals negative shareholder equity. This is a critical fundamental red flag, indicating liabilities exceed assets. While the AI narrative and contracts are strong, that underlying financial structure means that for most investors, this is a stay away. It was a cautious buy recently, but this fundamental issue pushes it down to stay away today.
So despite the AI excitement, Dell is a stay away for general investors due to those deep-seated financial concerns. Let's look at Firefly Aerospace, FLY. The sentiment is bullish, with users excited about its potential in national security and lunar exploration, backed by a significant contract backlog and insider buying. It's seen as potentially undervalued compared to some peers, making it a tempting play in the space industry.
Ethan, I get the long-term vision and the excitement for the space industry. However, the KPIs tell a very different story. Firefly has deeply negative net profit margins, negative EPS, and negative operating margins. This company is burning a lot of cash, which is typical for early-stage growth, but with a very high debt-to-equity ratio, it presents a significant financial risk. It's an extremely speculative play, and as such, it's a stay away for most investors until there's a clearer path to profitability.
Firefly Aerospace is a stay away due to those high risks. Moving on to IBM, International Business Machines. While it was mentioned in the AI Manhattan Project discussions, the real buzz for IBM is its substantial $10 billion bet on quantum computing and the potential for federal funding in that space. We're also seeing strong insider confidence with significant net share purchases. For a mature tech company, its revenue growth and return on equity are quite decent.
Ethan, IBM's strategic pivot into quantum computing and that strong insider buying are certainly positive signals. However, the company is carrying an extremely high debt-to-equity ratio, over 211, which is a major financial risk. Its PEG ratio is also quite high, suggesting that much of that exciting quantum computing future might already be priced into the stock. IBM has frequently been a stay away in our ratings, and despite the promising future in quantum, the current financial metrics suggest it remains a stay away for new investors.
So IBM, despite its quantum ambitions, is a stay away. And finally, MicroStrategy, MSTR. Now, this one's always a lively discussion. While the original post was bearish, the social media community largely interpreted it as a contrarian signal to go bullish. There's a strong belief in a crypto market reversal, and users are even correcting the original post's financial claims, noting debt repurchase instead of dividends.
Ethan, the contrarian sentiment is strong, but we must look past the hype to the underlying fundamentals. MicroStrategy's debt-to-equity ratio, even after debt repurchase, remains extremely high. Critically, it has massive negative earnings per share and effectively zero net profit margin because its primary business is holding Bitcoin, not generating traditional revenue or profit. Its beta is extremely high, over 3.5, indicating extreme volatility. This company is fundamentally a highly leveraged proxy for Bitcoin, making it a stay away for anyone not fully comfortable with extreme speculation.
For MicroStrategy, it's a definite stay away. Last, but certainly not least, let's talk about Virgin Galactic, SPCE. This stock has seen massive community optimism and, frankly, a lot of pumping activity. It just capped its best month ever. There's news of a new investor, and they're preparing VSS Unity for new flight tests. Plus, we're seeing huge insider buying, which is usually a great sign. The targets online are wildly optimistic.
Ethan, the hype and insider buying are undeniable. However, the KPIs for Virgin Galactic are frankly catastrophic. We're looking at significant negative revenue growth, massive losses per share, an extremely negative operating margin, and a debt-to-equity ratio over 142. This company is profoundly unprofitable and burning cash at an alarming rate. While the flight tests and new investors are exciting, they are bets on a highly speculative future. We had this flagged as a speculative gamble yesterday, but given the severe financial distress, it's a stay away for any investor prioritizing fundamentals.
That's a strong caution, Brooke. Virgin Galactic is a stay away due to those severe fundamental issues, despite all that community enthusiasm. All right, let's recap our AI-generated insights for today, Monday, June 1st, 2026. Investigate as buy. SAP SEADS, Microsoft Corporation. Investigate as cautious buy. Micron Technology, Inc. Investigate as speculative gamble. Virgin Galactic Holdings, Inc. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. That's all for today's Daily Hunt for Multibaggers. Thank you for tuning in, and we'll be back tomorrow with more AI-generated market commentary.
Until then, happy hunting.